Brilliant. Okay, thank you, everyone. Good morning. My name is Aron Betru. I'm the Managing Director for the Milken Institute Center for Financial Markets. Thank you for joining us for what I hope to be a great discussion on de-risking emerging markets investments. We're going to try to dazzle you with statistics and stories from the field. Some of you may get so excited you might do a crowd wave. Just don't block the camera, okay? I need proof this session happened. So the theme for this conference is navigating a world in transition. And I want to share a couple of points just to accentuate exactly what we're going to unpack here. Everybody's well aware of the differentials between the growth rates of emerging market economies and the G7. Emerging market growth rates, I think top 5 are all north of 7%. G7, at best, if we're lucky, 4%, and most of them are actually negative growth rate. Yes, I know the base is a different thing, and so it's not a fair comparison, but these are real numbers. That's one point. Second point, post-2008, we had a need for the global financial institutions to have much more stability on their balance sheet, more financial regulations, but what that translated to was effectively the top 600 financial institutions having north of $4 trillion on their assets that really impeded growth in the emerging markets. They deleveraged significantly. And the third and final point, the one that's really relevant for this conversation, is in 2015, we had an inflection point in terms of how the development community started to react to spurring development. In 2015, we shifted from the MDGs to the SDGs. The MDGs, which were focused on the Millennium Development Goals, were focused on essentially donor-led development finance, ODA, Overseas Development Assistance, to now the Sustainable Development Goals, where the international community is recognizing the importance of developing countries themselves, and especially the private sector, financing much of development. Now, I don't mean the global financial institutions putting CRS, essentially putting things in orphanages or things that are not commercially viable. I'm talking about what the Business and Sustainable Development Commission had identified. There's like $12 trillion worth of commercial opportunities that are aligned to the SDGs. And so all the folks here on the stage are touching this subject matter in one shape or form in terms of how do we find that balancing act between the different incentives of private capital, but making sure that they do it in a way that provides the right risk-reward trade-off. And so what I'm going to do is ask everyone on the stage just to take 30 seconds, share with us your name, your organization, exactly in a brief way how you touch up on the subject matter of emerging markets investments. Let me start on that end, Jukka.
Yeah, good morning, everyone. My name is Jukka Pihlman. I work in the Public Sector and Development Organizations group of Standard Chartered. Those who don't know Standard Chartered, we are very much focused on the emerging markets, Asia, Africa, and the Middle East in particular. And the SDGs, we are a very strong believer on them and subscribe to them. We actually have concrete goals on each of the SDGs, and we actually think that this blended finance is a very important tool in achieving those.
Good morning. Thank you for having me today. I'm Keiko Honda, EVP and CEO of MIGA, Multilateral Investment Guarantee Agency. We are part of the World Bank Group, and we set up about 30 years ago to promote foreign direct investment, in other words, bringing private investors into the developing countries by providing the non-commercial risk mitigation.
Thank you.
I'm Kate McCarthy. I'm a partner based in Washington, D.C. with Clifford, an international law firm, and I act for both multilaterals like IFC and IDB and others, and I act for banks who take cover from the multilaterals like MIGA and the export credit agencies, so I see both sides.
Jeremy Carter. I'm the Chief Credit Officer of Fitch Ratings. I'm based in London, and we look at these guarantees from the entities that we rate, so the banks and the insurance companies, but also project finance and structured finance transactions often use these guarantees.
Hi, good morning. I'm Mike Eckhart. I'm the Global Head of Environmental Finance at Citi out of New York in corporate and investment banking, so I call on our 12,000 corporate clients around the world, mostly dealing with the financing of renewable energy. We also have our Global Head of Public Finance all of the government finance here in the room. Julie Monaco in the white jacket. See Julie later if you want to see the government public finance and myself on the corporate finance. Also, lastly, just quickly, Citi is an organization. I'm quite proud to be at this group. The other banks are also excellent, but we have a commitment on sustainability. Just published our Citi and the SDGs report. You can get that off our website. We have a $100 billion commitment to sustainable financing, and we're well ahead of that goal. And we've also, as an institution, committed to 100% renewable energy. So I think we walk the talk as well as do the work.
Thank you, Michael. Now, when we talk about de-risking the emerging markets investments, I think one of the questions that we're trying to unpack a little bit is that whether it be public sector stakeholders, the NGO community, everybody's pounding their fist and saying, why isn't private capital at the door investing alongside the UN Sustainable Development Goals? And I think it's an important question to ask. Essentially, how fair is this? And Jukka, your role within Standard Chartered, which is a global bank that actually has a footprint in a lot of the countries that we're caring about, can you share a little bit your perspective of, is this a fair question to be asking private capital, first of all?
Well, I mean, the numbers that you mentioned earlier, and there's a lot of estimates on this. I mean, I think the UN says that the gap in achieving the SDGs is $2.5 trillion a year. So it's very, very clear that the governments, the public money is not going to be enough. So there will have to be private sector investment into the SDGs. And of course, you know, banks like Citibank and us, we have been doing that work for a very long time. But it's also quite clear that even the banks' resources are not enough. So the big question here is how do we mobilize the hundreds of trillions of private sector investors, so public sector pension funds, sovereign wealth funds, and insurance companies, and all those long-term investors, because a lot of these projects would actually naturally fit in what their liability structure would define. The problem that we see, I mean, like, of course, the question is fair. Is the risk and return trade-off, is that a fair one? And I think that, you know, the biggest issue, and I think that this is something that we discussed earlier and when we were walking in, is that this topic has been discussed decades. And I think that the key issue still is the perception of risk, not necessarily the real risk. I mean, there's actual data out there that, you know, like the Moody's default data on infrastructure projects. In fact, the infrastructure defaults are actually less in Africa than in North America. So you know, the actual risk is perhaps much lower than the perceived one. I'm not, of course, saying that there's no risk. I mean, like investing in Africa is something that requires boots on the ground. It requires local expertise, and I think that this is where the multilateral institutions actually play a very crucial role. I mean, not only are they, I'll come back to the guarantees, but you know, they are also providing a lot of assistance in the project design, you know, the regulatory environment, laws, and everything. All of these are something that are kind of prerequisites for the private sector money to come in. Having said that, this is already, you know, the emerging markets have taken long strides in this, and you know, we have been on the ground investing, and one thing that we notice is that there's actually not enough of bankable projects for us to invest. We would like to invest more. So I think that this is an area where the multilateral institutions can perhaps even do even more in facilitating that. But given the topic, you know, we're talking about guarantees. I mean, that's obviously a very, very important. We are a strong partner with MIGA, World Bank, and the bilateral development institutions that you know, use guarantees. So I just wanted to kind of briefly mention the importance of the design of those guarantees. You know, there's a link to the regulations and regulatory capital. I mean, like, there are different guarantees out there. Some, like the MIGA's NHSO guarantee product, gives banks who are using that a full capital relief on the amount. And these are obviously, this is something that then, you know, once you get the full capital relief, banks can pass on the savings to the end borrower. But there are also guarantees out there that are only partial and cover certain parts of it. They are important, but I think there's a little bit of an anomaly that in the regulations, we as banks get basically zero capital relief from that. So it's a binary thing. So it's either 100% or it's zero. And even if that, like clearly there's a risk reduction there, but we can't necessarily pass that on to the end user.
So it matters how we do the de-risking is a key point, but at the end of the day, from a risk-reward trade-off, you're trying to find that balancing act, which is kind of an interesting point. And I actually wanted to shift a little to Michael on the end from Citi's perspective. When you're looking at actual transactions, there is a lot of interest in, as you mentioned earlier, in terms of leaning in a little bit. But when you're getting a deal done, is your vision of what's needed for the countries as well as for the deals themselves shared by the credit committees? How hard is it to get some of these deals executed?
Well, to put things in context of time, I want to say we're making progress at a very fast rate. It just doesn't get done in a day. And just to give perspective, even in the clean energy, renewable energy space, there's a lot of other SDGs, a lot of other climate issues, adaptation, mitigation, and so on. But just for example, these technologies have been under development for literally 40 years. In terms of financing, it was a milestone not announced that clean energy reached the bond market, which was the target for 40 years, to get the long-term low-cost debt capital to effectuate the technologies. We actually reached the bond market in 2013. There was the first yieldco, which is equity market, but it's a fixed income security. The first solar securitization, the first energy efficiency securitization, and we drafted the green bond principles all in the summer of 2013. It was a huge achievement, 40 years in the making, okay? So we've only just begun to crack the capital markets with these kinds of things. Now, the important solution that we achieved there, I would point out, is the public sector and the private sector are obviously extremely different in the way they work, and I know you all understand that. But what we're hearing, and I want to correct, is that what we're hearing from the public sector side is, from their view, they need to get the public sector capital to come into these issues. And I say, well, it doesn't work that way in our world. That's the public sector way. You get thematic investing. We don't do thematic investing, so it doesn't work. What does work is bring the climate issues to the private capital. It's the other way. I say if you're thirsty, you don't ask the river to come to you, right? You go to the river and get a drink. Same thing here. The capital is there. There's some $212 trillion invested in our capital markets, over $50 trillion held by the banks. So there's $250 trillion of capital available, but it's not going to come over here. It tends to want you to come to it. And that's our job as banks and investment banks, is to make that translation, and that's what we're working hard on doing. That's what we spend all day doing, is managing risk, identifying risk, managing risk, mitigating risk, so that it qualifies for the investment criteria that are established by people like my friends at Fitch, S&P, and so on. There are criteria there. We don't make them up. They are set, and we have to meet those criteria, whether it's Citi or IBM or GE or Intel coming to get capital. The capital doesn't come to them. They have to go there and qualify for these existing criteria. That's what we're working on with the SDGs right now.
So that's the two key points that I want to underline. One, the role of financial institutions, specifically banks, as intermediaries in being able to bring the different types of capital together with a particular project. One. Second thing, those criterias, essentially, that define when you do want to step in and when you don't want to step in. And Jeremy, I'd love for you to kind of jump in a little bit here from Fitch, as one of the world's largest rating agencies, that provides a little bit of that guidance on those guidelines that different folks on either side of a deal need to be looking at.
Yeah, sure. So I'd say from the banks and insurance point of view, we very much follow the regulatory capital rules. And actually, just raising a point that you made earlier, it's not all banks can receive zero risk weighting on these. There's two ways under the Basel capital adequacy rules that banks can judge their capital. One is the standardized approach, and one is the internal ratings-based approach. And for eligible guarantees, you can switch out the obligor for the guarantor. So in many cases, if you have a single B minus obligor and a AAA rated guarantor, then you're switching out 100, 150% risk weight for a 0 risk weight. So it's hugely beneficial. But you can only do that if you meet all of the legal and operational criterion, and one of which is prompt payment. Basel doesn't define prompt payment in the standardized approach, but a lot of national regulators are looking at kind of 60, 90 days. Many of these guarantees have 180-day plus payment periods. So that means that they wouldn't qualify under the standardized approach. There is a little bit of a ray of light on that for the banks under the standardized approach that want to do this. For example, recently the UK PRA issued a consultation paper where it was looking at making guarantees that have a 0% risk weight guarantor from someone like the World Bank, a supranational, exempt from that timely clause. Under the internal ratings-based approach, which I think is what you were referring to, it's split between PD and loss given default, which means that you don't have the same prescriptive criteria. So you could say, okay, even though we have a high probability of default, we have a very, very low loss given default because we expect that guarantee to come in. So I think that's really on the bank's insurance side. As far as us, I think what Mike was talking about, us rating transactions on the project finance and structured finance side, I'd say there are really two important points that are worth discussing. One is the fact that Fitch is a first dollar of loss rating agency. And that has a big influence on these things because many of these, they're partial credit guarantees. So maybe they might guarantee as much as 95% of the principal, but there's still 5% that's not. Now, we're a first dollar of loss agency, so if you're going to lose 5%, you're still going to lose. So we can't give very much benefit to that. And you can, we've seen different structures, and I think it's probably worth just spending a minute.
What's guiding you, your principles on that, essentially?
So that's really what our rating definitions are. Okay. And so anybody that uses Fitch's rating definitions, or Fitch's ratings, is expecting our rating to address that likelihood of losing any money, rather than an expected loss style of methodology. And
so when there's new laws coming in to fold or guidance coming in from the Basel Committee on shifting in most of those countries from Basel II to Basel III and the finalization of 3 and 4, where do you see the trend actually going forward?
So what I'd say on that, again, that's shifting back to the banks and insurance companies. What I'd say is the most interesting development on those recent revisions was in December, when the Basel Committee came out with a revised approach for risk-weighted standards, which introduced an output floor, very similar to in the US, your Collins Amendment. And what that is doing is it's saying that it's limiting the benefit that you can get from an internal model approach to 72.5% of your standardized approach. Now this puts a lot of, I think this puts a lot of pressure on these guarantees to become eligible under the standardized approach. Because if they're not, then suddenly that's a very different world for all banks under the standardized approach or the IRB.
Thank you. I think it's an important point to kind of take a step back and actually explain why this is quite relevant. In most of the emerging markets, they're still trying to implement Basel II regulations and have essentially a set of standards that is making it a little bit harder for global financial institutions to engage. And I'll give you two examples. On one end, the push for finalizing 3 in particular requires, if you're going to do equity investing, you need to have 250% reserves. What that translates to is reserves are expensive. It's a disincentive for a global financial institution to say we want to step in if they have to hold that type of reserve. The other thing is there's rules with regards to currency exposure. So if you're a global financial institution with a local branch, and that local branch in that country does a local currency denominated transaction, the HQ has to actually treat that as a foreign currency exposure, even though everything is being done in local currency. So there are certain rules that are meant to increase financial stability in the system, but the flip side of that is actually a disincentive for global financial institutions. And you heard Jukka make the point that to achieve the SDGs is trying to mobilize something like $2.5 trillion on an annual basis. And where is that going to come from? We need to bring in global financial institutions to help finance some of these things. And the big thing to transition to MIGA here, that's I think a critical point, with the donor community recognizing the importance of private capital, it's to realize the role of shifting from when they were providing just ODA grant to de-risking private capital to come in. And MIGA is the big 800-pound gorilla in this, with more than, I want to say, is it $18 billion?
$20 billion.
$20 billion of guarantee exposures in the emerging markets. It would be wonderful if you kind of share your thoughts on the subject.
Sure. Well, since discussion getting very, very technical, and I really don't know the audience who really kind of wants to hear about like very technical side of the discussion. So therefore, if I may, can I just going to kind of bring up a little bit of, bird's eye. First of all, as a member of the World Bank Group, MIGA shares the twin goals, which is eradicate extreme poverty and boost shared prosperity. And of course, as Jukka said, we are working to achieve the sustainable development goals. Then also, I just like to kind of give you one statistics. 1994 is the first year foreign direct investment surpassed ODA, official development assistance. But last year, FDI was 6 times of ODA. So private investment is very, very important. MIGA is supporting about $20 billion of private investment into like developing countries by providing non-commercial risk mitigations. And to actually achieve the sustainable development goals, government, DFI like us, and a private investor have to do a lot of things. But first, there are a few things to address. Some people think that what is missing is financing. But experienced financiers for development finance, such as commercial banks, Citi, or the Standard, and many more probably in this room, they have liquidity. This much, therefore, in fact, rooted in the scarcity of investable project. To convert these financing needs into the investable project, developing country government, DFI like us, and private investors have to work together. Let me start with MDB, because we do understand that we have to play that big role. By the way, there is Stephanie, she's the new Chief Operating Officer of IFC, is out there with the, I don't know, black or blue jacket. So she and I probably can entertain some questions together. But our understanding is, first, we need to help reform the sector with the government and mainstream the upstream. So meaning that we should advise government, for example, to set the tariff at the realistic level. I think this is very, very important, since ultimate beneficiaries actually willing to pay. They know power is not free. They know going to hospital is not free either. So, we really need to think about how to set the appropriate level of the tariff. I know politicians have to face the elections, but they also have to watch out the balance sheet of the government, since one of the agenda during the IMF World Bank spring meeting actually was debt sustainability. So we really need to work on this level.
Make it commercially viable for both the country and the financier. I am
not really saying everything is commercially viable, but at least kind of set the tariff level. It's appropriate, and if it's not commercially viable, we have to ask in the short term. I'm not really saying forever. Short term government to come in to help us. So I think this is very, very important. This is the one, like, IFC pushing the word under the creating markets. I think we also like to support that. We really need to create the markets for private investors to have to come in. I'm sorry, this is the kind of step one. Yeah. And then of course, we can be creative. We can also discuss with the regulatory bodies how the regulation have to be set, so therefore create enough incentive for the private investors to come in. But I think first, before going to talking about that regulatory issue, I'd like to kind of point out, first we really need to set up the converting the needs of people in developing country into like investable project for private investors to first of all going in.
Got it. No, that's a critical point. It's essentially every stakeholder has their right place, and it's the sequencing that really matters. Can you actually talk a little bit about actually the MIGA's primary role in terms of de-risking private capital, and essentially, as we look at the larger development community, I would say something like a research program that was done at OECD that found 45% of the private capital that's mobilized comes from guarantees, which is typically 5% of donor institutions' budgets. But MIGA is actually one of the leaders in this space and is actually increasing its efforts in there. It'd be great just to understand a little bit of that work.
Well, thank you very much for advertising us. Well, as far as I understand, we're probably the largest multilateral development agency for providing risk mitigation instruments. We have two products. One is for the private project, or PPP. We provide so-called political risk insurance. The specific risk that we are covering is transfer, restrictions in convertibility, breach of contract by the government, and expropriation and war on civil disturbance. I think another new product we introduced about 6-7 years ago it's called non-honoring of financial obligation, which Jukka just mentioned, NHSO. This one, for the public project, like a government operates, we support enhancing the sum of the eligible government bodies to finance.
So MIGA, US government, British government, the World Bank, a bunch of different organizations that are out there, they're providing these various guarantee tools, de-risking tools. And one of the things that the Milken Institute actually ended up doing was taking all the legal agreements from all these organizations and working with a number of you on the stage and actually scoring them to see how well they provide the balance sheet relief for financial institutions, the intermediaries that Michael was talking about, such that they actually do finance some of the transactions. And working with Kate here, we uncovered some interesting insights. Essentially, 80% of the guarantee market, development guarantee market, more than half of them were inefficient in terms of complying with some of the standards that Jeremy was mentioning. Kate, you've been at the center of a whole suite of deals that actually was trying to find a way of blending commercial and concessional financing. Love to hear your thoughts on this space.
Yeah, I mean, I think just picking up on something that's been said before, I think this whole debate should look at both banks and non-banks, because when I say non-banks, I did a lot of project finance in Latin America. Probably the single most well-known entrant to the market in the last 5 years is Goldman Sachs. And you think, what the hell is Goldman Sachs doing, doing Latin American project finance? But the reality is there's classes of investors for everything. People are chasing yield because, treasury bills pay nothing. So you can take any risk that you want, and as long as it's clear and identifiable, people like Goldman Sachs will find a buyer. So when I hear about these goals of raising money, the bank community, which I act for a lot, and it's shrunk because of Basel, and it's never going to grow again, and it's never grow to these needs. There is just piles of money out there. So when I look at these products, I think we have to focus not just what the banks need and Basel, because that's a bank issue, but actually what this broader financing community needs, because everybody in project finance in the more emerged markets like Latin America looks to the bond market. The banks will tell you, clients say, I need a straight to bond solution. It's all about getting it to a long-term bond. And one of the big reasons is infrastructure needs long tenor. It's really difficult for banks to give 10, 15, 20-year tenor. Road deals need 20-year tenor. The bond market can give that. So I think that's the first thing we all have to look at, is being creative with these products and looking what's the barrier both to the banks and the non-banks. Now, it turns out a lot of the barriers are the same. Non-banks, so I mean raising a bond issue. Goldman Sachs gets institutional investors, does a bond issuance, right? They don't have Basel requirements, they're not regulated. But they have the same issues. If you have conditionality, so this guarantee can terminate midstream, that will destroy a bond rating. You know, for Fitch, it will destroy the rating just as much as it will destroy the Basel treatment. So anything that puts risk outside of someone's control back onto them is a big issue. So my main plea on these products would be to say, listen, look at structuring ways so the risk on a beneficiary is within its control. Otherwise, it's just not going to work. So a classic example, what's conditionality? It's usually in the form of a covenant to do something. So there's a world of difference between the very laudable goals of the development community and saying, we want our projects to be environmentally friendly. There's a world of difference between saying, you beneficiary must ensure that the project follows the World Bank environmental guidelines, as an example. There's a world of difference between that, which destroys Basel treatment, to you must write in your loan agreement that the borrower must do this and you must enforce that covenant. That's easy. That's what MIGA's been doing in its policies. It means that all you do is you get your lawyers to write it in the loan agreements, and then when they tell you to enforce it, you enforce it. That works. The other big plea, and this runs through all DFI products, is clarity. Lots of export credit agencies, DFIs, they're guilty of this. They'll write very generic covenants that say, I mean, the classic one in the ECAs, the export credit agencies, they'll say, you know, take steps to mitigate loss, or don't do anything will increase the risk of loss. Sounds fine. And then a bank says to me, well, I've just got a waiver from the borrower who wants to increase debt and build something else. Can I say yes? And we say, well, I don't know. If you let them take more debt, they might default on all their debt and this debt, so I don't really know. That sort of thing is very difficult. Financiers are really clever people, and as long as they know what they have to do, they can do it. But they really want to know, what do you mean specifically? So I think that's it. And then the other thing that we've touched upon is this ability to sell down risk and to allocate the percentage that's uncovered. I get more questions from banks about that point. How can I allocate this uncovered bit than any other topic on this? They all want to know, because again, there's classes of investors for everything. There's investors who have to have sort of 100% cover, officially or synthetically. And then there's other people who say, hey, I'll just take a skim on the margin and I'll take 90% cover, it's fine with me. Allowing the class of investors to kind of allocate where that skin in the game lies is important. But the other thing is, these development needs require long-term money. Nobody wants to lock up capital for 10 to 20 years. And bankers are incentivized directly. They get paid based on the fee income to the group. They get paid on how many upfront fees they generate this year. They don't get paid based on the interest rate to the bank. They're all incentivized to do a deal, sell down, get the money back, do a new deal. So allowing that's key.
Can you unpack that a little bit, that last point in terms of getting a secondary market and the fee side of things? Essentially, intermediaries, allow them to be intermediaries. Yeah. What constraints have you seen in some of the transactions that actually prevents that?
Well, the classic one in these policies is, so again, if the agencies will always need to control who has their, you can't have a World Bank group guarantee going to someone on the World Bank debarment list. It's very obvious. It's just completely conflicting with policy. But to say, here's a policy, whether it's MIGA or it's a World Bank PRG or an IFC guarantee, to say you can only assign this to banks, financial institutions who are not on the World Bank debarment list, not on UN sanctions list. That's a universe everybody deals with, no problems. If you say instead, you can't assign to anybody that might harm my reputation, everybody goes, well, what does that mean? I have no idea if I can ever sell this. And you're locking people into, it's the underlying loan, it's not the guarantee, it's the underlying loan.
So most of the guarantees have these rules with regards to just purely either A, no assignability to another party, or B, if you're going to assign, you have to have our approval in advance, which actually slows down the whole process around getting things off of their balance sheet.
Yeah, or up front, it's for some people they literally can't because they're saying, I have to know I can sell this off my balance sheet and free up the capital within a certain number of years. It's a real barrier in practice to whether they want to do these deals.
So the conditionality, the certainty in the process, and the assignability, all of these things, which I guess, Jeremy, are...
Yeah, I mean, they're all exactly the points that we look at. And so the point that you were talking about, I mean, tranching that risk, it's no exaggeration to say that can make the difference between BB and AAA.
Yeah.
You know, if we can just substitute the obligor for the guarantor, then that comes to AAA. If it's just a recovery point, then it may get no benefit in our rating at all. If it has a very high recovery rate, then we may be able to give it a 2 or 3 notch benefit.
Yeah.
But that might be 2 or 3 notches. That might take you from BB to BB plus, BB minus. With that extra 5%, it might take you all the way up to the World Bank's rating.
No,
So
that's a key point, because, and also with new Basel regulations, these things are tightening up going forward. And so, Michael, from a bank's perspective, when you get these type of credit enhancement tools, how does Citi react then?
Well, let's say, just to pick up, I'll make 2 points. One is the big question of what world do we live in today in banking, and how do we differentiate that from banks to non-banks, which is the point you were raising. And on that, in just a friendly way, Paris Agreement on Climate, SDGs in 2015, Paris was done in COP21, the banking regulations came out of Basel III. So, we live in kind of a world that's competing COP21 versus Basel III. That's the reality that you were trying to get at there. And that's really real, that you're all depositors in banks. I'm a depositor in a bank. We don't want our banks to be just freewheeling with all of our capital into any possible application. So that's the banking regulations, and we agree with them and we operate under them. And as you pointed out, it has constrained what a, quote, bank can do. And that's opened up 2 things, the non-bank finance sector and then the capital markets again. And we as a bank lender are limited to our capital. We have just under $2 trillion of assets to advance, and we don't call making a loan, we call advancing our balance sheet, just to get it in our mind about what we're doing for our shareholders. But we also are an investment bank from the 20 years ago mergers in the banking business. And that means we do have access to that non-bank finance capital and the capital market capital. And that is our other principal business. And so whereas you may not get a long-term loan, or say a project financing may have a project bond, an equity component, and a short-term facilitation construction loan from the banks of less than 3 years. It's packaging all those pieces together that's today's financial world. Now, I would like to introduce one new element to our discussion of guarantees and credit enhancements, and that's the number of deals. I mean, we work with MIGA, and MIGA is a great institution, but I think it's accurate to say that MIGA has done under 200 guarantees in 40 years of existence, whereas we currently have about 10,000 projects under development under the SDGs currently at one time today. At least 5,000 of those 10,000 are going to need a credit enhancement. Where's the facility where 5,000 projects tomorrow simultaneously can go even to apply? So that's where I think we need to go.
Well, that's a key point, to be honest with you. So
Okay.
within the development finance community, as I said, 5% of their budget goes to the credit enhancements to get things done. 95% of that capital within the budgets of the multilaterals, the DFIs that are out there, is going to try to do direct lending, which they have a much smaller balance sheet. And I guess there's this question of the role of the multilateral development institutions and the DFIs that are out there to actually credit enhance to get greater leverage.
Well,
That's the question.
and Aron, by the way, ran a guarantee fund, which he's very modest. But what I'm really raising is where's the institution that I can take 100 of our projects simultaneously to apply for various levels of credit enhancement. I'm raising that institution might not exist.
Yeah.
It may not be a task of existing institutions, whether it's MIGA or Citi or Standard. There's a new need here, and I'm saying I think we need a new institution. What do we have to say about that?
I would just raise one thing, and it's just the statistic you just gave. So I'm sorry, I'm looking at Stephanie because she's IFC, and I act a lot for IFC on the lending side. But the message from the market is very much, look, what the multilaterals have is loads of people have money. Citibank has money, Standard Chartered, everybody has money, right? What they have is something incredibly rare, which is AAA rated balance sheet. There's like 7 left on earth. The US doesn't have one. The UK doesn't have one. It's like Germany and 3 Scandinavian countries in the multilaterals. So to me, the message from the market's definitely, sorry to look at you again, but is very much, don't make A loans anymore, we don't need them. But if you took all that capital, you're just doing these straightforward loans, and you made guarantees, and you took specific strips of risk, because that's the key thing. The leveraging effect of that AAA rated balance sheet on the market is enormous. So, you know, anybody can make the loan. Well, not anybody, but lots of people can. But there are nobody has a AAA rated balance sheet other than these institutions. And so, and I think what we're seeing in the deals that are really interesting is the multilaterals and agencies taking strips of risk. So you're bringing in all this private capital by taking a strip of the risk, not the whole thing. So you take the strip of your balance sheet and you really leverage it to get to a much bigger mobilization of capital, which is the goal here.
I would fully agree with what's being said here. We do have to remember, though, there are some new kids on the block. So we have the AIIB, we have the new development bank, who are actually, you know, when you start things from scratch, you know, they are in a better place to actually start using it in a way that they are very much looking into to the guarantees. And I think that, so whether we need a new institution, I mean, we spoke to there's now a G20 group also looking into the blended finance, the eminent persons group, which is really focusing on this aspect. So I think that, you know, where that may be heading is, you know, just using the existing institutions, but giving them more resources. I mean, the World Bank, the IFC, they got more capital, but as Michael pointed out, I mean, those numbers are still tiny compared to what the actual needs are.
Are multilateral development banks crowding out private capital?
You know, let me say it this way. You know, we actually try not to crowd out the private institutions, including private insurance company. The reason is we have 181 member countries as a shareholders. I have to tell you, most of them, not only they have a AAA, but they have fiscal deficit. So donors' money is getting more and more scarce. So really need to think about that, how to leverage donors' money. So I think what we're really talking about is how to kind of share the risk among the private investors and developing country government, and then maybe donor society. We have to come up with some kind of optimal point. I hear you because of the regulatory reasons. You know, some of the people kind of expect MDB, especially through the MDB, donor society take more risk. But the question is, you know, Jeremy, how much UK government is really contributing to the world and really, really supporting us. But I see, you know, there is a limitation to it. U.S. government, OPIC has been backed up, which is great. But also, you know, U.S. government is also have a limitations, and most of the government is the same way. So by the end of the day, you know, creating new organization is great, but the question is who will be funding and how to do it. MIGA, by the way, I think the reason we said we are relatively large, because we have a very good low loss history of 30 years. We have done 830 projects in 111 countries last 30 years, but our loss is limited. Because of that, we are able to mobilize primarily private reinsurance market. We have increased reinsurance amount about $10 billion last 4 years. That's include Lloyd's syndicates and so forth. So that's why I think, you know, my proposal, I'm not necessarily saying because I'm head of the MIGA, but I'm just kind of looking at very evidence-based. MIGA is probably one of the institutions that we can, we can leverage more for the world. But to do so, I think this is a great opportunity to hearing from rating agencies, as well as, you know, like a top law firm, as well as, you know, very, preeminent, you know, our private investor clients. I think we are open to hear more how we can be better. But I think please understand, donor society do not have the endless resources.
No,
So
I mean, but that's the key point, right? So we've got an institution here that is very big at de-risking. It's not probably, I would say it is the preeminent de-risking multilateral organization that's out there. Jeremy, definitely jump in terms of how that matters for you, and then I'd love the banks to come in as well.
So I was going to bring it right back to the conversation that you two had at the beginning, where it was about the efficiency of those documents. And I think maybe that's an area where you could start reviewing. And again, to come back to the timely point, not for bank regulatory capital purposes, but maybe for the ratings of project finance and structured finance. When we're reviewing these transactions, because there's so much uncertainty regarding when the guarantee will actually pay out, in some transactions we have 2 years or 4 years worth of liquidity gap there, and so those ratings can be much lower, or the transaction has to have a very large reserve fund or liquidity facility to reach the same rating. So it's not about necessarily putting more capital at play, but it's the rules at which that capital is put out that have a very large impact on how we view the risk, and I'm sure how others view the risk as well.
Yep.
Well, I think the question of somebody crowding out somebody is changing. If our goals, as it was in the past, was let's just proceed with our businesses. Yeah, occasionally a World Bank loan would bump aside a commercial loan, and somebody would complain and remember that for a career. Okay, right? And keep saying it over and over. But in reality, now the world has changed. We've got these climate goals, we've got these SDGs. We're talking about now the need to mobilize trillions of dollars a year for social purposes in all the countries of the world where there's a mix of creditworthiness, and we've got 10,000 projects going at the same time, at least half of which need some credit enhancement. And I'm saying we just don't have the institutional wherewithal established to deal with the current situation. As it's not the 1990s anymore. We're dealing with a whole different thing. We need 1-day turnaround on credit enhancement decisions, not 6 months or 6 years. I know our record with MIGA was a guarantee on a financing of the Turkish Exim Bank, and that was 6 years in the making. I don't know many solar developers that can wait 6 years. But we did on that one, and it was a great deal, and it worked out just great. But we're in a new world, is what I'm saying. A new way of dealing with credit enhancement in many places on many subjects, not even just solar and wind, but think about the 17 SDGs, my God. So I'm encouraging this, and I'm encouraging this on this stage because the Milken Institute. I wouldn't say this in Washington, that would just lead to studies. But really the Milken Institute, I did make a recommendation real quick. How many of you have ever been a developer? 1, 2, okay, and me, 3 in a prior life. And I'll tell you what keeps developers from going. Why are there a shortage of bankable projects? Because developers make a decision, should they send a team of people there to work on your nickel, you're paying their salaries and their hotel bills, while to develop a project, there has to be a high prospect of success, right? Okay, well, just look at all the developing countries. Why don't you go there? Because there's a risk that really the public sector doesn't want to address, which is the likelihood that if you succeed, you still won't get paid. Right? The utility's poor, they're broke, they don't have the cash to pay you every month. Now you can't make your debt service because you can't, so you won't even go to that country, is what I'm saying. So just a little thing like an offtake guarantee mechanism could unlock thousands of projects. There's a different way of thinking of guarantees now.
You had a comment?
Yeah, can I just make a comment? Well, thank you for saying that a SMFDB loan was sometimes used for the project which private investor can invest. World Bank Group announced a new initiative. World Bank, IFC, and AS are working on initiative called Maximizing Financing for Development. What this one really means is when we review the project to see whether private investor can operate or finance or not first. And if they can, we work with the private first. If it not, we also have to work with the government to kind of change the industry and so forth. But that was announced, I think, last October. So we are working on it right now. And G20 has been helping us, and we would like to work. But only things we can do is we would like to work with you. I see some of the people also from the government side. This may not be so easy because for the development government side has another step. They have to land the RFP and auction. They feel like it's additional step. Having said that, many of them are supporting us. So that's a new development.
Fair enough. Jukka, did you have a comment?
No, just going back to Michael's point on the innovation and what needs to happen. I think one aspect that has not been really touched upon in this panel is the currency risk in these lots of these projects, and I think that it's already happening. But I think that what should happen much more is that the multilaterals and these guarantees could also be given to the cross-currency swap or the hedging transaction, because especially the longer-term ones would also attract a high capital charge. So we have actually done a transaction with MIGA where they have guaranteed the swap exposure. Yep. So that's something that I think that if everyone kind of brought into their toolkits would be very useful for the banks. Yep. If I may just on the grants as well, I mean so to me one low-hanging fruit in this overall context is the currently if these countries are giving guarantees, it doesn't count as ODA. So if we come up with a standard document which would be a comprehensive credit cover, that actually you would think that should definitely count 1-to-1. In fact, it probably could count more than that because it would actually attract the private sector capital. So that's something that I would think that a lot of countries would probably become a little bit more innovative in the way that they do give grants, because this would have this catalytic crowding in effects. I mean, the Swedish SIDA is they're kind of pioneers, and I think OPIC there are institutions that are doing that, but I think that could be something that could unlock quite a bit.
Yeah, what you're stating is actually a critical point. So all the different institutions seem to have different methodologies and approaches and different types of legal terms within their agreements that actually creates a lot of complication probably for the rating agencies and even evaluating them from the first perspective. And so that's one of the things that was uncovered in the research assignment. And by the way, I think we have first copies of it are in the back, so you can pick them up if you want to. But we have about 10 minutes left in the room. I want to open it up a bit. We have country representatives in the room, banks in the room, non-banks investors. Any questions, if you have them, we have a microphone there. We have the first one right here.
Yeah, hi, I'm Rodney Ferguson from Rock International. I'm just curious if any of you have had any experience yet with the Green Climate Fund and whether there's any conclusions you've been able to draw. Is this going to be an easier organization to get credit guarantees? The preliminary word on the street is not so much. It's looking to be no less difficult than some of the other guarantors that we've heard about. So,
why don't we get two questions and then we'll come back. There was one over there in the middle. Over there.
Hi. I'm Arya Green from Gigawatt Global. We built the first Power Africa utility scale field in Rwanda, outside of Kigali. Michael, what you said spoke not just to my heart, but to the 5 years that it's taken us to progress from initiation to not yet, but soon financial close in our field in Nigeria. We work very closely with MIGA, as I know Ms. Honda. There's no question that we just came from a discussion this morning about sub-Saharan Africa and the energy needs there, and everybody agrees we have tremendous needs to fill. And here we're talking, and you're quite right, the Milken Institute Global Conference has opposed to Davos or other conferences, very, as we say in Israel at least, tachlis oriented, very bottom line, practical. And I think the issue of a potential new body to help coordinate is a good one. But one of the questions I want to ask you, this panel, is how can we help to incentivize, and yes, there's a self-interest here, but I'm making it general. For us as a developer and a platform, with a pipeline of some 36 projects in 12 different countries across Africa. We are desperate for the kind of investment at a very low level for the pre-development work and the development work that you pointed to that takes so much time and effort, the money to put someone on a plane and to have people in the field and to do the feasibility studies and then negotiate the MOUs and the land agreements and the PPAs and what have you. And we're desperate for that. We have people clamoring to provide project finance, equity and debt. And I'm talking about the largest companies in the world, the African Development Bank and other development banks and other groups. Nobody's willing to make that step to say, okay, here's a few $1 million, not billion, not trillions that we know are out there ready to go into projects. Every part of our discussion here has been project related. How do we mitigate the risks in projects? My question to the group is, how do we mitigate the risks? How do we incentivize or encourage companies, banks, impact asset oriented foundation asset managers to invest in the companies that are actually out there doing the work but need to have the wherewithal, to have the patience to make the things happen?
Thank you for that. Final question. I think there was one over there. Oh, okay. So we can, two questions that we heard. One was on the green bond facility, and the other is essentially financing the pre-work as well as essentially the institutions that are driving it. Anyone on stage?
I'll take Green Climate Fund. I've been saying this for several years to everybody, including Mr. Gutierrez and Jim Kim and everybody, that I just pray and wish that the Green Climate Fund, instead of being set up as a lender, because they have $10 billion over 10 years or something, and keep in mind the Citi alone, we're just one of the major banks. We do $10 billion in debt transactions a day, right? Just to put it in context of how big is the market, how big is the capital markets, how big is the SDG market, the climate market, how big are these markets? And $10 billion in a lending facility just has slowed things down in many countries. Okay, now what could it have been? And I still encourage a conversion to it, and it's halfway converted now from having spoken with the executive director. And that is, what if that $10 billion was the reserve fund on the guarantee agency that we've been talking about? It would have leveraged $1 billion at a 1%, right? That's the power it could have been. So since those conversations, they have put up $500 million for a possible guarantee mechanism, a backstop. But there is no reserve fund for the guarantees we're talking about. So to me, the guarantee agency is missing, and then what's missing from that is the reserve fund behind said agency. So if we can allocate some capital to it, and by the way, I'd like to say I'm only here because I was known as Solar Bank in the 90s, and I worked under a contract under Windrock International. So thank you, sir. You're the reason I'm here. Okay.
That second question about the financing the pre-work and the institutions, anyone want to touch up on that?
Briefly, I think mainstream, the upstream is very, very, very important. I appreciate all developers doing excellent work in many parts of the world. The World Bank Group set up the GIF. I think this one, we meant to help you more. And also, in addition, I think, of course, it's not a preparation phase, but during your investment phase, including both construction time and then operation time, MIGA is here to help you. We have doubled not only annual guarantee, but also portfolio last 5 years. And we like to continue to work on it. I think as I just mentioned, probably guarantee is most capital efficient form to support the development financing, since our paid-in capital is $366 million. Then we're mobilizing about $20 billion of private money. And also we have a very strong reinsurer behind of us. We like to continue to work with you.
That sounded like a deal was just made on the stage.
Final
question.
We're doing it. We're doing it.
Final question.
Thank you. I am Ambassador Kobe Crimson, former ambassador of Ghana to U.S. Just came back about, thank you. I just came back from Southern Africa, Namibia, South Africa, Ethiopia, and Ghana. And I just wanted to share a new paradigm, a new avenue of investing on the continent. And that's companies that are coming from the Middle East and some European companies, and we know China is there, that are now looking at small investments that don't require sovereign guarantees, because most of the countries are up to here with debt, and their debt to GDP does not, my country included, does not allow them to take on additional debt, or even provide sovereign guarantees. So what is happening now is, and that's something that we're promoting, where companies can come in and look to do small projects, say power plants, where it is 5 megawatts, 10 megawatts, 20 megawatts, up to 50 megawatts. That may require up to $30 million, and they bring their own money. The only thing we do is we provide them, we work with them, with the local government, to provide them with good power purchase agreements for 15 years, 20 years, so they can recoup their money. And the caveat in what they also offer is, at the end of the 20 years, they give the project back to the government. You see, these are new avenues that are beginning to be very attractive to some of the governments that we've visited. So something that we may give some consideration to, because some of these companies are coming with their own money, and some may need some money, but the amount of money required is so small. Housing projects in Namibia, $5 to $10 million.
Thank you. No, I appreciate that. That's a question of trying to figure out the right balancing act between things that might become public goods for the country. In a final question that I actually want to raise myself as a parting one, we heard essentially a question about the companies in the countries, how do they get financing? And I think there's a question of why aren't the local banks actually stepping up? This ties it to the theme that we've been discussing today in terms of how financial regulations work into either incentivizing private capital. Whether it be from the Basel Committee or local financial regulations, there are risk-weighted standards, and those things actually have created premiums on the sovereign bonds that are in a particular country. And local financial institutions find quite a lot of return by just investing in government bonds rather than investing in the real economy. Second, we also have how it treats the different international investments and as well as the guarantees that are meant to de-risk them. All of these things are being driven by this push towards greater financial stability on one side, and principally the same G20 countries from their point of view, from the regulator's perspective. But those same G20 countries are also supporting the push for development finance, the push for essentially blending private capital with public capital and finding a way. These are the same countries, but just different sides of agencies that are creating this disincentive and conflict. I'd love, as a parting thought to each of you, final 60 seconds or maybe even 30 seconds, because I see the card raising over there. How do we reconcile this point? I'll start on this end and we'll go this way.
I mean, that's the $2.5 trillion question. So I mean, I really do think that the perception issue is something that we can all work on. The multilaterals, there is data out there, but it's not necessarily public. So if you are an institutional investor, you trust data. So that's something that I think the multilaterals can certainly help with. The other is what has come up many times is the project design. I mean, I think that's something that is of utmost importance, creating those bankable projects.
Thank you.
Okay. Well, thank you for $1 billion question, maybe $1 trillion question. I still think how to risk share development countries, government, and donor society, including maybe MDB like us, and then private investors. And I think among the private investors, my guess is vast majority of you are private investors. Let me focus on my next 30 seconds. I think among the private investors, there are some private investors like a commercial banking project finance team, like SocGen and Citi, have expertise, understand how to kind of do things. And also there are different types of investors, such as institutional investors, insurance company, pension fund, who actually face a different regulatory environment. Is there any way we can structure the project so therefore in the beginning of the project, setting up the deal, and during the construction phase, those experienced financiers take more risk, and then passing over to the other types of investors who have more longer tenor duration of money, but come with a different return?
I would say what you've just said is the future, and it's what everybody talks about. Certainly for not maybe Africa, but Latin America. But I think the bonds generally can take lots of risk. They don't need a one-to-one dollar guarantee for the life loan. They just need construction. Once the thing is built, you can have a quite good project that they'll take the risk on. But you've got to get it so if you just take construction risk off them, you can raise a massive bond issue for an infrastructure financing. The guarantee, the balance sheet that gave the guarantee is freed up in 1 or 2 years to do another one. And then you've got a 20-year project that's going to build power infrastructure assets in the developing world. Now, that's not necessarily as easy for maybe parts of Africa as it is in Colombia, but that's absolutely the future, is the taking it to the bond market, taking it to operations. Bonds can take that. So.
Yeah, I would agree. I think that clarity of the purpose, decide what the purpose is, and then have the documentation make it very, very clear on that purpose. And that allows structured instruments, project finance, structured finance, to come in and make more efficient uses of these things.
Thank you.
I'd like to follow up on the ambassador's comment that some companies come with their own money. Very important thing that we didn't discuss today, but I'll mention briefly, and that is the existence of what we as a bank have that governments and MDBs don't have. You know what that is? Clients. We have clients. They do work. Like when people say, why doesn't Citi come to Africa? I say, get our clients to come. We come for free. We're chasing their business. And existing today, and let me say this as a declarative statement, we will not achieve the climate and SDG goals by project financing everything. It's too inefficient, too many legal bills, too much time, too complexity, okay? We need corporations to handle that without paying legal. That's their business. They do these projects. It's called utilities and energy companies and so on. Now we need SDG companies, okay. But companies can do this, and what we do to make it possible is we raise money in the background you don't see called stocks and bonds. Then they do the projects with that capital, and there's no project finance. Very efficient, very fast. This is going on today. In some of the very big companies you see winning auctions around the world in developing countries. We're behind them issuing green bonds a year later where they get their capital returns. So there are some dynamics here that Milken can also point out to the world, bring the parties together and say, look at powerful financing and how it works.
So I love that how Michael just dictated what my next agenda for the next year is going to be. But so thank you for everybody, your comments today, for the questions from the audience. At the end of the day, it is about finding the right mix. Thank you.
Enjoyed this a lot. Yeah.